Namaskar friends, welcome to the channel JIV and CAIV Made Simple. Today we are going to discuss our unit number 24 of AFM. Chapter name is Capital Structure and the Cost of Capital. This is the super important topic and easiest topic. If you understand the concept clearly, you will feel confident, you will feel much easy to solve the question. So let's get started. So whenever a business start or whenever a business grow, it need money. Now the thing is, this money is required for two big things. Either for creating the fixed asset, as you can see, for creating the fixed asset like building, machine or computer, or to run the daily operation. That is like paying salary, buying raw material, electricity bill. So this part is called working capital or financing the current asset. So one example of fixed asset I have given you, like suppose you are building machinery or computer, and working capital means raw material. Suppose you are buying raw material or electricity bill. Right, these are things under working capital. Now for fixed asset, a business usually need long-term fund. Very good. So obviously long-term fund is required for creating the fixed asset, right? Because these assets will be used for many years. Even a part of the working capital is financed through this long-term fund, right? So long-term source of capital are required for creating the fixed asset. Okay. What is the long-term source of capital? Means those source of capital which are longer term, which you have taken for long, like a loan which you have taken for 15 year, 20 year, like that. Okay. And one more point, even a part of the working capital is financed through this long-term fund. Yes, it also finance working capital fund. See, let me show you using the balance, this particular balance sheet. Suppose this side we are showing the asset. So on asset side we have either working capital, which is the current asset, and other we have the fixed asset, right? Fixed asset, this is called fixed asset. On the liability side, this is the liability or source of capital. Asset is called use of capital. In liability side, we have some part as capital, right? And the some part as long-term source, LTL, long-term source, and some part as short-term source. So basically, what we are doing, try to understand that this fixed asset portion is funded directly by this long-term source, and some part of this working capital is also funded by the long-term source, right? So long-term sources are being used for two things. Now, what exactly is net working capital? See, it simply means the difference between the company current asset and the current liability. I told you now that a portion of the net working capital is also used to meet the company daily requirement. So if you subtract the current asset, right? So if you subtract the current asset and current liability, that will give you the NWC. When we say capital, see what is the meaning of this term capital? When we say capital, we are talking about the long-term money which is needed by the business. The money can come from two main sources, equity or debt. Equity means money invested by the owner. So equity means, investment, money invested by the owner, right? And this is called risk capital. This equity is called, risk capital, right? Because the business, if the business suffer loss, owner bear the risk. So remember, equity is called the risk capital because if the business suffer loss, owner will bear the risk. Second kind of source of capital we have is called debt. Debt means money borrowed from lender. Debt means money borrowed from lender, right? Which has to be repaid with interest. Finally, the mix of equity and debt in the long-term fund is called the capital structure. Yes. If you mix both of them, debt plus equity, if you mix both of them, right, in the total long-term fund, that is called what? Capital structure, right? In simple terms, this capital structure shows how much of the money is the owner money and how much is the borrowed money. So either you can borrow by debt or either you can invest by a risk capital. So you can see clearly written here, capital structure simply means the proportion of debt and equity in the total long-term fund raised by the firm, right? So whatever long-term fund the company has raised, okay, how much of the long-term fund is by debt and how much of the long-term fund is by the equity, right? And what is the use of the long-term fund? I think you know it, either for creating fixed asset or for financing the working capital. So how much part of the long-term source is being used for financing the working capital is called the net working capital. That is called NWC. right? That is the point. Now friends, let's look at one example given in your book. Let's understand capital structure with a simple example. Suppose that there is a company, they raise 500 lakh. Suppose a company raised 500 lakh as the long term fund. So they have raised 500 lakh as a long term fund. Out of this, 60% is debt. 60% means what? 300 lakh. 300 lakh is the debt and 200 lakh is the equity, right? So the mix of debt and equity is called the capital structure. This is called capital structure. Now suppose a company has more debt in its structure. Suppose the company has more debt, as you can see here, 300 lakh is debt. So more debt is there as compared to equity. So if a company has more debt in its structure, we say it is highly leveraged or highly geared, right? We say it is highly leveraged or highly geared. On the other hand, now friends, let's understand the capital structure with a simple example. Suppose the company has raised 500 lakh, okay, as a long term fund. Fine. Out of this 300 lakh, okay, that is a 60% is the debt. And the rest 200 lakh, right, rest 200 lakh is the equity. 200 lakh is the equity, which is how much? Which is 40%. So basically, this mix of debt and equity is called the capital structure. This is called the capital structure, right? Now, if a company has more debt in its structure, now think about it. Suppose a particular company has more debt in its structure, right? So what it means? We say that it is highly leveraged. As you can see, highly leveraged or highly geared firm, high ratio of debt capital, right? On the other hand, if it has less debt or more equity, it is called low leverage or it is called the percent is the equity. So if a company has more debt, it means it is highly leveraged. On the other hand, if it has less debt, it means it is low leverage or low geared. Now the question is what count as debt capital? So let's look at some example of the debt capital. As you can see, these are the examples of debt capital, like term loan taken from a bank, debenture issued to investor, corporate deposit, fixed deposit collected from the public. These are the example of debt capital. And what counts as equity capital? What are the example of equity capital? So partners capital in the firm, partnership firm, equity share, preference share, right, issued by a company. Then the profit that a company keep with itself instead of distributing them, that is called retained profit or undistributed profit. So in simple word, capital structure tells us how much of the business money is borrowed and how much is earned. Yes. So this part shows the borrowed one, right? This part shows the borrowed one and this part shows the earned one, right? How much of the business is borrowed, money is borrowed, and how much of the business is money is earned. Now let's talk about the factors influencing the decision on capital structure in a firm. So what are the factors that influence a company capital structure decision? In other words, how a firm decide how much debt, how much equity to keep. How a firm decide. Let's talk about it. How a firm decide how much to keep it as equity and how much to keep it as debt. So there is something called norms prevailing in the financial system. They decide norm prevailing in the financial system, right? So basically, bank and financial institution follow a strict rule, right? They have a strict lending policy. They will not allow a company to borrow beyond certain limit. For example, they check the prescribed debt equity norms, debt equity ratio before giving the loan. Even the rating agency look at this ratio before giving a credit rating, right? So that is what are the norms prevailing in the financial system, like debt equity ratio. Based on the debt equity ratio, right? They decide that this much loan should be granted to this particular company. They will not allow a company to borrow beyond the certain limit. Then we will dilute. To avoid this, many promoters prefer debt instrument. So let me explain what I'm talking about. Degree of control means what So promoter, right? Promoter are there, or we call it owner are there. What they want? They want to keep control of the company. They want control, right? So suppose if they issue more equity share, suppose if they issue more and more equity share, what will happen? This will cause the dilution of control. This will cause the dilution. So they don't want it. They don't want it. So how do they avoid it? They avoid it, right? They prefer debt instrument, because by issuing more and more equity share, their control will get lost. So they avoid it by using by issuing. They prefer debt instrument like debenture because these don't reduce their control. I hope it answered the question that what is the meaning of degree of control, right? Third point is, so we are talking about what are the factor, right? We are talking about how a firm decide how much debt and how much equity to keep. The third thing is the trading on equity. The third point is the trading on equity. So what is the meaning of this trading on equity? See, this is an interesting one. When a company already has equity, it can use that equity to raise more debt. If the business is doing well, the profit earned on equity capital increases with the debt. In simple word, debt can act like a booster for equity return. Yes, this is what we can infer from here. That this debt, they can act like a booster. For what? This debt can like a booster for the equity return. Right. This is the point. So that is called trading on equity. You can see written here. So basically, when a company already has equity, it can use that to raise more debt. If the business is doing well, the profit earned on equity capital increases with the debt. Right. As business is doing well, so as you are taking more debt, so profit which we are earning on equity will also increase. Right. So debt can act like a booster for equity return. And the fourth factor is the cost of debt. This is the big risk factor. If a company ignores the cost of debt and borrow too much, it may enjoy high return only when business conditions are good. But if the market turn bad, the heavy burden of interest can make the company unviable and in worst case insolvent. Right. That is the impact of the high proportion of the debt. Right. So as and when the market is doing good, the business is doing good, high proportion of the debt will result in increased return. But adverse business condition, it will cause debt cost affecting the viability. Right. So a company must carefully balance debt and equity because too much of either can create problem. Like if you have too much equity, this lead to the dilution problem, dilution of ownership problem. And if you have too much debt, then it will cause, we have seen, if the market turns down, if the business turns adverse, right, the debt cost will affect the viability. Now friends, let's look at the decision. Yes. So this factor we have already talked now. Right. Size of the firm. Next factor that affects is the size of the firm. A large company with a stable operation and no big expansion plan may choose more debt in its structure. See, suppose there is a large company, right? See the point. Suppose there is a large company, okay, and this large company has a stable operation. It has a stable operation, right? It has no expansion plan. Large company, a stable operation, no expansion plan. It may choose more debt. It chooses more debt in its structure. While a fast growing company may prefer equity. On the other hand, we have a fast growing company. It will prefer what? It will prefer equity to reduce the risk. So the capital structure decision is never random. It is influenced by the financial system, promoter choice, cost consideration, even the company growth vision. Now, what are the theories and approach of the capital structure? When we talk about the capital structure theory, there are three main approach. The first is called NOI, net income approach. Second one is called net operating income approach, and the third one is called the traditional approach. You can see the name written here: net income approach, net operating income approach, and the third one is the traditional approach. Let's break these three down one by one in easy terms. First of all, let's start with the net income approach. Basically, if the cost of debt and the cost of equity remain constant, then by increasing the proportion of the debt, the company can reduce its overall cost of capital. The question is why? See what I'm talking about, net income approach, what it says that if the cost of debt and cost of equity remain constant, let me write it down. Let me show you mathematically what it means. So net income approach, so cost of debt and cost of equity, these two remain constant, these two remain fixed, okay, and then by increasing the proportion of the debt, if you increase the proportion of the debt, that is called weight of the debt, right, the company can reduce it, overall WACC will get reduced. What is WACC? This is called the overall cost of capital. This is called overall cost of capital. That's called WACC. Why? Because debt is cheaper than equity, right? Because debt is cheaper than equity. Lower WACC means higher firm value. So WACC decrease means firm value will increase. Okay, so this approach favor using more debt. It favor that you should use more debt. That's why we have written WD means weight is increasing. We are increasing the proportion of the debt. The company can reduce its WACC, and WACC reduce, firm value will increase. So this approach favor using more debt. That is what has been written. It assumes that CD and cost remain the same, as the cost of debt is lower than the cost of equity, right? So cost of debt is lower than cost of equity, increasing the proportion of the debt and can lower the overall cost WACC and increase the value of the firm. I hope it is clear. Very simple to understand. You can think of it like this. You know the formula? The formula is WACC is equal to WD into, that is the proportion of the debt, right? WD into cost of the debt plus proportion of the equity into cost of equity. Now you think about it. CD is less than CE, right? CD is less than CE, right? And we assume that they remain the same throughout. Okay. So what will happen? Since CD is less, I want this to reduce, right? So if WD is more, this overall will be less, and since this is less, so this will be less, and since this will be less, so firm value will increase. That is the point. That is what NOI tells you. NOI means net income approach, right? Then we have net operating income approach. Second approach we have is called net operating income approach. So basically, in simple word we can say NOI approach. First of all, let's talk about NOI. NOI assume that market value of the firm depends only on the operating income and business risk, not on how much debt or how much equity it has. So okay. So NOI I think is clear. Now net operating income approach. So net operating income approach. This one is called NOI. This one is called NOI. Non-net operating. This was NI. Right. It completely disagree. It says that the value of the firm does not change even if you increase or decrease the debt. What NI was telling that if you increase the debt, the value of the firm will increase. That is what is inferred from the net income approach. But NOI clearly deny it. NOI says that completely disagree. It says that value of the firm does not change even if you increase or decrease the debt. The question is why? What NOI tells you, let me summarize here. So NOI tells you that even if you increase the debt, that means WD you are increasing, this will not count any change in the value of the firm. Value of the firm will remain the same. Why? Because while debt give you benefit like cheaper cost, it can also increase the risk for equity shareholder. Yes, debt is obviously causing you CD to reduce, but at the same time risk is increasing. For whom? For equity shareholder. What kind of risk? I told you now. If the debt is higher and if the business turn bad, obviously it will be very much difficult to handle the situation. And when the risk goes up, right? What will happen? When the risk goes up, shareholder demands a higher return. Obviously, the return will increase. So whatever benefit you get from debt is cancelled out by the higher equity return requirement. So obviously, since you are increasing debt, thinking that you are getting benefit of the decrease in the cost, but whatever benefit you get is outweighed by the increase in the return. You have to give higher return. It is cancelled out by higher equity return requirement. So in simple word, we can say NOI approach believe that market value of the firm depend only on the operating income. It has nothing to do with the proportion of the debt and equity, right? So NOI simply says that market value of firm, this is the function of what? This is the function of operating income and the business risk. It does not depend on how much debt or how much equity it has. That means according to NOI theory, financial leverage has no impact on firm value or WACC. So this is called financial leverage, right? So it says that financial leverage has no impact on what? Financial leverage has no impact on firm value. So it means firm value is not dependent on, is not the function of what? Is not the function of financial leverage. Right. The gain from debt is the pain of extra liquidity risk. So obviously debt is providing you benefit, but it also increases the requirement of return by the equity shareholder due to increased risk perception. Right. So that is the conclusion, that the market value of the firm is dependent on operating income and business risk. Right. This is the point. So While net income approach say more debt increases the value, the NOI approach say debt or no debt, the value of the firm remain the same. I hope it is clear. So the NOI approach assumes that WACC or the value of the firm remain unaffected by the change of debt proportion in the capital structure. Right. So this is all about this NOI approach. Now let's look at the next slide. Now friends, let's go deeper into NOI approach. According to the NOI approach, market value of the firm depends on two things. Already I told you, market value is a function of operating income as well as the business risk, right? So neither of these is affected by the financial leverage. Neither operating income nor business risk. It is not. Both of these they are not affected by. They are not affected by what? Financial leverage. Both of them are not affected by the financial leverage. In simple word, whether a company borrow more or less, its operating income does not change. Its operating income remain the same. So whether a company borrow more or borrow less, its operating income will remain unchanged. Now here comes the interesting part, the formula for cost of equity under this approach. Yes, let's have a look at the formula for cost of equity. So the cost of equity formula is, what is the formula? First of all, you write WACC minus CD, cost of debt, multiplied by proportion of debt divided by proportion of equity. That is the formula. Here the WACC and the cost of the debt, that is called CD, right, are considered constant. So WACC is considered constant and the CD is considered constant. These two functions, these two are constant, right? The only thing that changes are the WD and WE. Sorry, WD means proportion of the debt and WE proportion of equity. Yes, cost remain constant and WACC also remain constant. And there is a simple link between debt and equity. So you can say that proportion of equity, that is WE, is equal to 1 minus WD upon total capital. Right. This is one relation between WD. WD means proportion of equity. WD means proportion of debt. So if a company increases that, suppose the company increases the debt, what will happen? The proportion of equity automatically decreases. You can see it clearly from this formula. So what does this mean in practice? So if the debt goes up while WACC remain constant, then the cost of equity will also go up. Think about it. Think about it. Suppose the debt goes up. The proportion of the debt goes up. Proportion of the debt goes up. WACC remaining constant. What is happening to the cost of equity? The cost of equity will also go up because suppose debt goes up while WACC remain constant. The cost of equity will also go up because shareholder now see more risk in the company, so they demand a higher return. Simply cost of equity means what? The return that the shareholder is demanding. Cost of debt means you are paying interest on the debt. That is the cost of the debt. So WD goes up, WE comes down, right? Since it comes down, so it will go up. Cost of equity will go up. Cost of equity is going up. It means return will get affected. Shareholder will demand more return. But that is the meaning. So in short, we can say that basically what we are decreasing WD. Debt may be cheap, but it increases the risk for equity holder. Yes, we can say that yes, debt is cheap, but risk for shareholder increases. That's why cost of equity rises as the debt proportion increases, keeping the WACC constant. Now the third method we have is called traditional position. Basically, this is the traditional approach to the capital structure. This one is considered more realistic compared to the net income, and net is more realistic, right? So remember the key point. This traditional approach is more realistic, okay, compared to the net income and NOI approach. The idea here is simple. Taking some debt is good, but take too much debt is dangerous. So you should take debt, but some debt. Some debt is good, but too much debt is dangerous. At first, what happened? Let me explain this using one example. Right. In this traditional approach we are talking about. So initially, when a company take debt, this is the company, right? And it is taking debt. So initially what happened? That overall WACC may reduce. Why? The reason is because the cost of debt is less than the cost of equity, right? This is the first reason. But after a certain point, what happened, that lender start seeing the company as risky. So lenders start seeing the company as risky. So the cost of debt goes up. At the same time, equity investor, right? So this is risky from the lender point of view. From the lender point of view, the company is viewed as being risky. Similarly, at the same time, the equity investor also feel the extra risk. They also feel the extra risk. So the cost of equity also increases, and it increases sharply. This cost of equity increases sharply when leverage get too high. When leverage is very, very high, right? So according to this approach, as leverage increase, so what this approach says, that we are talking about the traditional approach. So this approach says that as leverage increase, right? So it simply means WACC decrease to a certain level. What is the meaning of leverage? Means debt. To the WACC initially decrease to a certain level, then remain constant. For some time it remained constant, just like we have seen. In this case, early when debt was increased, WACC decreased after a certain point. So to some level it remained constant, and then after, since it is viewed as risky for both lender as well as the equity investor, it start rising again. WACC, weighted average cost of capital, increases again. Why? Because all of them view is right risky. So that means there is an optimal capital structure. Yes. So from this we can infer that there is an optimal capital structure, right? Optimal capital structure, a point where a mix of debt and equity give the lowest WACC. So you can see like this. If you see the graphical view of it, so you can see initially when you increase the debt proportion, when WD increase, so what happened? The WACC decrease. At a certain time, to certain extent, it remained constant, and then after it started again increasing. So you can see in this particular graph, right? On the y-axis we have WACC. On the x-axis we have CD, right? Leverage, or we also call it the leverage. So we can see this portion of the graph, which I have highlighted. Let me use different color. So I'm talking about this portion, right? This portion of the graph, WACC is minimum, isn't it? So a point where the mix of debt and equity give the lowest WACC and the minimum value of the firm, right? So that is what traditional approach is all about. Now let me just go through the line. So it is more realistic relative. Just now I told you that cost of debt increases beyond a certain point as the proportion of debt capital increases due to high risk perception by the creditor. Similarly, the cost of equity also increases with increasing leverage. So if you go through this wording, you will never understand what it is talking about. And if you go through this wording, right, initially what happened? Initially, as we increase the debt, WACC decreases. Why it decreases? Because cost of debt is less than cost of equity. After a certain point, what happened? Lender view it as risky. That's why CD increase. Equity investor also view this portfolio as risky. So C is also increase. Right. So when leverage in C increase multifold when leverage increases. Right. Same thing has been shown in this graphical point. So this particular reason, this is the optimal mix of equity and debt. This is called equity structure. Right. So that is the point. This is what traditional approach is all about. Now friends, let's move to the next slide. So basically, let's look at this particular slide. What we are talking about. Before we dive into taxation, let's first look at the basic assumption behind the capital structure theory. Yes. So these are the basic assumption. Right. Basic assumption that we make behind the capital structure theory. First of all, there are only two sources of capital. It assumes that there are only two sources of capital. The first is the debt, second is the equity. Then no tax are considered. There are no taxes, right? Neither personal nor corporate. Then the firm operating profit, which we call EBIT, right? It says that the firm operating profit is assumed to stay constant. EBIT stay constant. That is what is assumed. The company can change its capital structure anytime. The firm can change its capital structure at any time, right? Basically, and there are no cost for making this change without any transaction cost. You can see clearly written here. Firm can change its capital structure without transaction cost. Then the next point is, and finally, market is assumed to be permanent or perfect, right? Where all the investors are fully rational, right? All the investors are fully